Now, you can start, Stefano.
Okay, thank you very much to your professor Lucio Gobbi for the invitation. It is for me an opportunity to study again an old problem that I considered immediately during 2007 because I had the fortune to be a young researcher in an interesting department at University of Bergamo, where Professor Riccardo Bellofiore, a Marxian Minskian economist, was an expert of financial crisis and generally economic crisis. So we had the opportunity to discuss a lot between us and also with other visiting scholar. One of these visiting scholar was Andrea Orléans, a French professor that was also an interesting and original author of an hypothesis to explain the critical functioning of financial markets. This hypothesis is the self-referential hypothesis of financial markets. So during this lecture, I will try not only to explain the steps from the real estate bubble to the credit bubble to the global crisis that we lived during 2007. But I try also to obtain some theoretical notes on financial economics, and I will try also to stress the limits of the neoclassical theory of financial markets and to introduce a new way to study financial markets and financial crisis, putting at the core the self-referential hypothesis proposed by Andrea Orléans. And this is also the reason why I choose this title to this lecture, Coming Back to Subprime Crisis to Think About the Present. Last consideration for this introduction. I am convincing that the present is characterized by some mechanism that remember a lot the framework that deteriorated in 2007 to subprime crisis, that I consider a sort of mother of all the crises from 2007 to nowadays. Okay. The first step is considering a statement by Alan Greenspan at the middle of the 90s. There is nothing involved in federal regulation which makes it superior to market regulation. This is a proof of a new kind to organize the role of policymaker, especially in front of the financial investors. Very different, for example, from the Keynesian culture that dominated, especially during the 60s and the 70s. And it is a very strong statement that establishes the idea that federal regulation would be limited, because also in the financial markets, the best thing, at least in Alan Greenspan 94 opinion, the best thing was leave the market to itself. The market would be able to find its proper rules. But in October 2008, and this is the period in which the subprime crisis is recognized by everyone, the opinion by Alan Greenspan seems to be very different. I would like to quote the statement in its entire. I made a mistake in presuming that self-interest of organization, especially banks and others, were such is that they were best capable of protecting their own shareholders and their equity in the firms. So the problem here is something which looked to be a very solid edifice, and indeed a critical pillar to market competition and free markets, did break down. I found a flaw in my ideology. I don't know how significant or permanent it is, but I have been very distressed by the fact. I found a flaw in the model that I perceived is the critical functioning structure that defines how the world works, so to speak. And it is very interesting also because Alan Greenspan was the chairman of the Federal Reserve in the United States from August 1987 to January 2006. And he was considered, at least until 2008, a sort of genius, a sort of benchmark for all policy makers, especially inside the world of banking. A very funny image from The Economist is particularly meaningful. You can see Greenspan, and he said, "I'm shocked when we woke him up." It is the monster of Wall Street, the self-regulated financial market. I thought he'd behave himself. So we may have some doubt about the capacity to well behaving by financial markets left free to operate without the federal regulation. The subprime crisis. What is the subprime crisis? It is a classic crisis. It could be described as an housing bubble closely linked to a credit bubble. And the big problem is, haven't economists taught us that when in a competitive market prices increases, then demand weakens, which leads to lowering the price again? And this is not the case. The origin of the subprime crisis is in a housing bubble. And what is a housing bubble? Is a situation in which the prices of houses are permanently increasing. But this increasing, at least at the first moment, is perceived as the right way to price houses. And why this could be also the origin for a credit bubble? It is very easy. When banks see that the real estate market is characterized by increasing prices, it means also that houses can be considered characterized by increasing value. So the value of the houses can be used as collateral for opening new opportunity of credit also to people that generally in the past were considered not good for receiving credit, were considered subprime. When banks see that opening credit to buy houses is possible, then an housing bubble evolves, or if you prefer, could be considered the origin also to a credit bubble.
Stefano, I interrupt you just
Yes.
for a question. And according to you, is it easy to detect a bubble? Now we can say that it is straightforward looking at the past data, but considering the trend as and in the historical perspective in 2007, it was so clear or not. Well, for example, you compare this crisis with the dot-com crisis, because with the student, we will talk about the dot-com crisis. And so
yes,
I will ask you this opinion.
Okay. Obviously, I will continue after my discourse that I ordered in a specific way. Anyway,
well, if you want to ask to answer later, it's not a problem.
No, but it could be nice to open this discourse now, because it was also one of my contribution to literature. If you remember my article published in 2011 on International Journal of Political Economy together with Andrea Fumagalli. Yes, it is interesting to consider the internet bubble as a sort of previous step also for the subprime crisis, or if you prefer, to the real estate bubble. In which sense? In the sense that the dot-com crisis that I suppose you explained it in other lectures to your student, can be considered as a sort of spy crisis. It is not a real deflagrating burst of the bubble. It is just a sort of passage from a conventional judgment that dominated during the half of the 90s, the financial market, to another opinion, a public conventional opinion for financial investors in a context that was deeply deregulated by the policymakers. So when you had the burst of the dot-com bubble, you didn't have failures of the banking system, but and you also had the attitude by financial investors to find something for investing their liquidity that was abundant in the market. The problem of dot-com bubble was how to restart a new kind of trust in financial markets. And the abundance of savings on financial market that was originated by the new economy and by the dot-com bubble, this abundance of savings was the origin for the bubble in the housing market. So the abundance of savings was directionated to the real estate market. And this is, in my vision, the most relevant linkage between the dot-com bubble and the real estate bubble that preceded the credit bubble and the subprime crisis. Obviously, there are also other linkages in terms of theoretical framework that I would like to explain in this lecture.
Yes, thank you very much. Thank you very much, Stefano. Your position is clear, and okay. in a certain way, we can say that the 2001 crisis enhanced the system, given that financial market was able to withstand the shock.
Yes, but before this crisis, we have to stress the fact that we had a sort of new structure on financial market. If you think about, for example, the Nasdaq that was invented for measuring the value of the dot-com shares, you can see easily the fact that during the 90s, we have a strong step towards a new kind of regulation. I mean, a new kind of deregulation of financial market that is also a big revolution in the way in which savings are generally managed by investors and obviously also by banks.
Okay, the students have seen this kind of dynamic in Elector, so you can go on. Sorry for the interruption.
No, I think that it could be a right way to participate to this kind of lecture. I choose to share with you these data that are the best way for describing the real estate bubble. Obviously, in 2007, as I said before, this wasn't considered a bubble, but this was considered a right way to price the market by hypothesizing that something was changing in the fundamental of the real market, in the fundamentals that that were used to evaluate houses. And these data are described by the Case-Shiller Index. That is an index that refers to the real estate sector in US and shows the trend of real houses prices based on the moving average related to the purchases and sales recorded in the month under review and the previous 2 months. And as you can see, not only in the USA, but also in France, Spain, and UK, we have a growth rate of the index that is very, very high. 171% of growth rate of this index referred to the real estate sector in the United States, but in United Kingdom, more than 2,000% of growing rate in the index. And nowadays we can see that we can affirm that this increasing trend was undoubtedly an index of a real estate bubble. This second table represents the passage from the statistics that may describe a real estate bubble towards the statistics that may describe the credit bubble. The table shows the evolution of different types of loans over time. These loans are different contracts, different paths between the banking system and the borrower. You have here the adjustable rate mortgage loans and the loans interest only, and the incomplete or absent document loans, the so-called liar loans. And you have in the fourth column the quotient of debt service on household income, and in the last column the average loan value on the asset. So these loans are the witness of a sort of progressive facilitation, progressing easing in opening new kind of loans. The repayment due to growing debt affect the income of indebted households by an increasing proportion, as shown in the fourth column. And the average loans value on the value of the assets, as you may see here, exceeds 80%. This indicates an increasing fragility of loans. It is surprising to see how this increase in subprime risk is not accompanied in the period that we are here considered by a rise in interest rates, as the market's efficiency hypothesis would have it. And it should first be remembered that a financial asset is a claim on future earnings, which for simplicity, we can see as future dividends. And these future gains are highly uncertain. The problem is how to estimate the almost infinite flow of future dividends when we already know so little about next year's dividend. And this is a question that was very important in order to understand the blinding that affected the credit risk assessment in front of this kind of data. This kind of data, exactly as this other kind of data related to real estate bubble, were perceived until 2007 as a right way to fix value by interpreting fundamentals in a certain way. The idea that something novel was happening in market that can justify a change in the fundamentals. And this is exactly the reason because during the 2000s, a new way to assess credit risk, but also to record values in the budgets of banking systems were diffused. In the case of credit, it is necessary to limit the estimate to payment default risk. And we have three main variables. The risk of default should be described by, first, the probability of default. Secondly, the portion of assets lost by the creditor, the so-called loss given default. And finally, the expected loss. And to assess credit default risk, three major rating agencies proceeded by calculating the statistical frequencies of similar and homogeneous past events. But in the case of subprime loans, the available data weren't very old, given the novelty of the financial product. The only existing statistical basis was default cases related to 2001. Yet the subprime of 2001 cannot be considered a subprime in 2006. And this is all the more true in light of the rising trend in real estate prices. So a major part of the underestimation of risk is explained by the fact that the rating agencies, Moody's, Fitch, and Standard & Poor's, did not anticipate how quickly the housing market reversing its expectation. The credit risk assessment, in other words, was based on the housing values, that is, on the real estate market risk assessment. But the problem was that in the procedure to assess this kind of risk, investors were invaded by a sort of collective blinding.
So, Stefano, according to you, the problem was in the belief of on the efficient market hypothesis and in a wrong model utilized by a rating agency.
Yes, you are anticipated a point, and I also anticipate will anticipate one of my conclusions. In the perspective of Andrea Orlean, that is the perspective that I'm following during this lecture, the way in which Moody's, Fitch, and Standard & Poor's assessed credit risk is completely rational in terms of self-referential hypothesis. Why? Because the collective belief at the moment was so strong that if the credit risk assessment model wasn't different, Moody's, Fitch, and Standard & Poor's would be considered completely foolish. In a sense, just after the disaster, we may consider the irrationality of the collective belief that was dominating the market before. Okay, do you want a deeper consideration or may continue my...
No, for me it's okay. I don't know if students have some question. Yes, open your microphone. Or no, you can tell me your name. Alberto what? Alberto and? Ah, you are Alberto Barp.
Okay, Professor, do you hear me?
Yeah.
Okay.
Okay, I would like you to explain a little bit more about the self-references about the risk evaluation, please.
Yes, the idea is that if you are in a corporation like Moody's or Fitch Rating or Standard & Poor's, and you have to assess the credit risk to a phenomenon that has not an historical series, because as you may see, the period is very short, 2001 and 2006. And you are living in a world where everyone in the market say there's no problems for assess credit because the rate of the credit can be based on the market value of the counterpart, and the counterpart is the real estate market. And in the real estate market, demand is higher than supply. Then the prices of houses are increasing. Then, for the reason of the budget rules that dominate the market, the way in which you may put in the budget the value of the houses that your borrower bought is an increasing value. So you have exactly the collateral to justify your increasing attitude to concede credit to loan people that as only their house that they had to end to pay as collateral, but this collateral is characterized by an increasing value. So why in this framework you should consider, a ruler should consider a mistake the way to assess credit risk? It is completely logical if everyone accepts the idea that the housing market could be considered as a collateral of the credit risk assessment. And if you have also that the central banker, as Alan Greenspan trusted in the idea of mark-to-market model, it is not possible to stop this kind of logics. The problem is in the institutions, or better, the problem is in the collective belief that institution legitimates. Lucio, do you want to add something to this reasoning? Just
no. According to me, it's fine.
Yeah, maybe you can translate better this reasoning to your class by using also the notion you introduced during your previous lectures.
Well, we didn't look at VAR, and so sometimes it could be difficult for students to grasp this concept, but I'm sure that they have caught the idea, because here we are in a concept of management, and so we didn't look at this kind of stuff in a technical way. But I think you have been clear about the fact that there is sort of collective misunderstanding for what concern the evaluation of risk and the model used to evaluate this kind of risk.
Okay. Anyway, the other passage I would like highlight is the influence of collective opinion. So what is the way that we consider as the most scientific one to solve the problem of the risk assessment or the problem of the evaluation of assets is statistics. Statistical inference cannot establish an estimate that can convince the set of investors. Because in an uncertain situation where even scientific arguments are powerless, opinion eventually prevails. Once the market has been able to detect its actual ability to create wealth, it will vigorously argue its legitimacy. And so the right way to consider markets' behaviors is trying to put behind the efficiency market hypothesis for introducing the self-referentiality of financial markets. And let me introduce this point by remembering you the main pillars of orthodox financial theory that I suppose is also at the basis of your undergraduate courses, for example, in finance. Orthodox financial theory considers the equity prices, the stock prices, to be a reflection of the fundamental value of the firm, where the fundamental value is equal to the discounted stream of future expected dividends. So it assumes that every participant of the market seeks to estimate a sort of objective value because it is based on fundamentals. A different interpretation, the interpretation proposed by Andrea Orlean of financial markets, affirms that far more important for investors than the value of the discounted stream of future expected dividends is the price of equities, the price of shares at any given moment as decided by market opinion. Each investor seeks to anticipate prices. It is not necessary to assume that stock price is a reflection of the fundamental value or that all participants in the market base their prediction on this notion. The basic description of the market is self-referential, and it implies that the point of reference, the benchmark for understanding the stock prices, the equity prices, is an endogenous product of market itself. And rationality, this kind of rationality based on the self-referential theory is obviously more general than the fundamentalist rationality. Fundamentalist rationality could be just a case. Generally, rationality depends on a self-referential procedure, and it is focused on opinions of other participants who all influence each other. This is exactly what John Maynard Keynes described in a very important chapter, chapter 12, of the general theory that was devoted to the explanation of expectations on financial market and also on businesses.
Yes, student Stefano has already seen this way of reasoning because we play the beauty contest game, and therefore maybe it is easier for them to grasp this concept. Even if in class they have seen the neoclassical theory, but also the other mainstream theory, not the one you are explaining, but the new Keynesian theory, and in particular the Schiller papers and this kind of moving from the rational expectation theory. So we'll talk about the chapter 12 of the general theory.
Yes, now I don't want rubber you too much time. Anyway, we can interpret chapter 12 as a sort of first step towards an economics based on information asymmetries. But I'm not completely agree with this kind of interpretation of chapter 12. Indeed, this case that we are trying to think about today cannot be explained just considering a problem of asymmetries in the information. This is not a problem of asymmetries in information. This is a problem of a passage from a collective belief to another collective belief, where the mimicking that we may have between financial operators can be done also in the absence of asymmetries. It's a problem of heterogeneity, but again, we must be more general than asymmetric information hypothesis. Asymmetric information hypothesis could be considered as a particular case of the problem of self-referential hypothesis, because you may have asymmetries in the information when you have a clear hierarchy in the market between people that are more informed than the other people. In the case of subprime crisis, we have a sort of collective blinding. It is different. And this collective blinding, again, to anticipate one of the conclusions proposed by Orlean, is first of all a blinding by regulators. And you could exit from this crisis just by imposing a new way to evaluate assets. And obviously, as I think you are imagining, this is a problem of central banking. Do you want to add something to this?
No. It's just to mark the difference between your position and what the student have heard in our class. Here we only mainstream theory, both neoclassical theory and new Keynesian theory, not post-Keynesian theories or other kind of Austrian perspective or Marxist perspective, and so you have marked the difference between what they have heard in class and the fact that your way of reasoning and interpretation of Keynesian idea is quite a bit different.
I hope that my notes were quite clear. Anyway, as you know, my suggestion to students is trying to read general theory and to discuss together in a seminarial
Stefano, okay.
Okay. Anyway, I don't want to spend too much time to this passage, but I think that it could be a good way to deepen and to discuss the point that students may use outside the lecture for discussing together. This passage of Keynes that I don't want to read now can be interpreted by proposing this sort of conclusion. If the market is sufficiently liquid, so if you have confidence in some assets, the optimal strategy is to take advantage of the high gains the bubble provides and actively participate in it for as long as possible. Rising prices in this perspective, but this is the perspective of the market in when trust dominates market, rising prices result in increasing demand in this case. And again, it is very easy to see this. You have here in the first graph on my left the most common graph in the undergraduate courses in economics. Demand is decreasing. Supply is an increasing line. So when you have a situation in which prices are increasing, demand will decrease, because the idea is that the utility function of the buyer is characterized by a situation in which when price goes up, then it is more difficult to buy commodities. This is not the case of financial markets. Why? Because if you have an asset, you can also sell tomorrow this asset and obtain a capital gain. Then, if you buy a house and you expect that this house will increase its value tomorrow, it will be reasonable that the increasing prices of the house will increase the demand in the housing market, in the real estate market, and also it will lead also to a facility in credit market. Then, in this perspective, that is the perspective of financial markets, that is based on a liquidity principle, demand is increasing. When prices increase, then demand will increase. But if the first equilibrium in the graph on my left is a stable equilibrium, the second equilibrium is unstable. Then, so far we have not made any reference to securitization. For you, it could be strange. Generally, if you read the history of the subprime crisis, you will find the idea that the problem was securitization. Also, for example, in the movies based on the history of this crisis. But we wanted to show that the crisis is not at a deep level inherently caused by securitization. Instead, it originates in the inefficiency of the pricing mechanism in the real estate and credit markets based on self-referentiality of the market itself. Securitization in this perspective amplifies the crisis. It concerns the phenomenon in the extent of its effect. And just to remember what securitization is a financial technique that consists of transforming loans listed as assets, the so-called mortgages, into marketable securities. Loans are collected in several blocks and sold to mutual funds, which are later sold to investors in the financial markets in form of bonds. At the end of the last century, although the market has already conquered a large part of the evolved financial system, a very large slice still eluded. That was the bank credit market. Because of its specificity, this is not subject to a market evaluation. If you give a loans, you cannot sell these loans. Bank loans, in this way, until the new regulation, or if you prefer the deregulation, banks remain liquid, kept by banks on their budget books until they are repaid. But in the financial perspective, in the Wall Street perspective, in the perspective based on the mark-to-market evaluation, this was a serious distortion of the principle of liquidity, which wants financial assets to be able to be traded, to be freely traded in the markets. A condition in accordance with the efficiency hypothesis that was considered the right way to mark the market assets. This is what securitization is all about, subjecting bank loans.
Stefano, I interrupt you. Can you explain to student what mark-to-market is? Because we have just talked briefly.
Very easy. If you study accounting courses, what is the way to give a value to an asset in your budget? You have the old principle of the historical cost, obviously, but this principle was started to be overcome by a new logic, exactly in 2000. And this new logic is the mark-to-market logic. I want to write in the budget, in my balance sheet, the value of the asset by considering the way in which market at the moment give value to this asset. And what is the way to do this? Demand and supply analysis. It is a mark-to-market hypothesis. It is not a mark-to-model hypothesis, or if you prefer in the European language, typical in the accounting, the historical cost perspective based on which principle? The so-called prudency principle that was introduced, for example, by Luca Pacioli in the roots of the accounting law. During the beginning of 2000, we assisted to a big revolution in the accounting principles. The prudence principle was overcome for accepting, also in Europe, the USA perspective based on the mark-to-market way to put value to the asset in the budget. And this logics, at the end, was also accepted by credit system in organizing their way to treat loans. Bank loans could be considered, by following Wall Street perspective, an asset, a liquid asset. Is
okay,
clear?
Thank you, Stefano.
So this is what securitization is all about, subjecting bank loans to the common law, turning them into tradable assets to be liquid in order to apply the mark-to-market principle, or if you prefer, the fair value principle. Fair value or mark-to-market are exactly synonyms. So the securitization is a new step toward the extension of the crisis. The credit bubble was financed by structural products or derivatives that was the financial tools used to sell loans by banks. So first step, real estate market with increasing prices of houses. Second step, credit market. Increasing houses prices are considered the collateral, or if you prefer, the justification to open new kind of loans, the subprime loans. Third step, applying the fair value logics to loans for trading loans on market by using particular new kind of financial instruments, the structural product or derivatives. You can find here the three most used derivatives during the subprime crisis, or if you prefer, in the period before the subprime crisis. Here you may find their definition, the asset-backed security, the mortgage-backed security, and moreover, the collateralized debt obligation, the CDO, that are fixed income securities that are not regulated in the markets. The issuance of CDOs is done by a special purpose vehicle to which a portfolio is given. And this portfolio is often heterogeneous, is built on different pieces of bank loans that are negotiable on financial markets, and they are ranked in different tranches.
Okay, Stefano, it's not necessary to go in the technicalities.
No, I don't want to go on the technicalities.
To give them an idea, so you can describe only a typical
yes,
product.
I
like
would
in
like
this slide.
I would like to describe the CDO structure, not entering in techniques, but first of all, look at this Wall Street Journal image. As you may say, the subprime mortgages that are the derivatives is represented as an unstable equilibrium in which you have brokers, banks, securities, and the phrase below is very interesting. I thought we were just buying a house. And on this house, a new kind of evaluation principles has been built that contributed to extend the critical roots of the financial markets. As you can see, in this slide, the 80% of subprime loans were based on senior tranches of a specific derivative, the mortgage-backed securities, that was rated AAA, that it was a very high rank. About the 2% are tranches rated speculative or below, and or are rated equities. The remaining 18%, 11 plus 4 plus 3, were financed by tranches that are considered mezzanines, whose ratings ranged from AA plus to BBB minus. The collateral debt obligation, the CDOs, were created from these mortgage-backed securities tranches. The high grade CDO, you can have different type of CDO. The high grade CDOs were created from tranches of MBAs and CDOs with good rating. As you may see, you have the 80% of senior AAA tranches, and the only 75%, 62 plus 14% of the tranches that composed the so-called CDO mezzanine are rated AAA. Most of the A minus and BB tranches are recycled again for another derivative, the CDO squared. And in this way, the 80% generated of the CDO square, 60% plus 27%, generate senior and super senior tranches. And in this way that some analysts describe it as a sausages. You know that the butcher, when do sausage, insert in the sausages some good meals together with bones, treated bones or other kind of junk meals. And this is the idea. But why? Why? Because in this way, subprime loans were 95% financed in the form of securities rated A, AA, or AAA. What is the idea? It's the old idea that you have to differentiate the risks. So if you have some junks bonds together with some trust that you can consider very good, everything could be okay. But this is a very ingenuous perspective. Why? Because the problem is the correlation between the different tranches. If the junk tranches are correlated with the senior tranches, you can assist to a reduction of the values of the junk tranches that will affect also the reduction, the decreasing value of the senior tranches.
Sorry, Professor.
Yes.
I have a question. So the fact is,
Stefano, 10 minutes left.
Yeah, I would ask for the question.
Okay, sorry, I didn't get it. Does anybody have a question?
Well, yes, I'll try to be quick. The fact is, as you said, they were all package correlated, and even though they were correlated, they were like qualified as diversified. So to which extent can we trust the rating agencies? I mean, I need to reformulate this because, as you said, they were declaring it safe assets because nobody wanted to scare anybody. So was it only a reputational stake, or the rating agencies had more stake in the game? And can we, after
the problem are
these crises,
the roots of the problems are not the rating agencies. The roots of the problem was the regulator, was the idea by Alan Greenspan that market can be the optimal way to rule the market itself. This is the problem. When you have that a central bank renounce to govern the expectations, you will have that the collective belief that will dominate the market will be based on the idea of fair value. And if you have this model as a collective opinion, it will be completely reasonable in this perspective that the rating will be done by following the dominant model. That's the problem. The rating agencies were applying just the dominant logics legitimated by the regulator. That's the point. And by following these logics, the idea was, for example, the not correlation between the AAA tranches and the other tranches. And if you see, for example, this graph, until November 2006, that is, sorry, the period that we may see on the bottom of the slide.
Well, Stefano, we can say that the correlation was blurred, but because the market was dragged by the intervention of the Fed.
Without intervention of the Fed.
Well, in the sense they have an expansive monetary policy.
No, let me reach the point. I'm just at the moment at the beginning of the crisis. So until November 2006, the risk premium that we can measure by the ABX index, referring to subprime portion rated BBB or BB minus, is close to zero. You can see from this graph. In November 2006, many institutions lending to high risk borrowers failed. Why? Because the real estate market start to encounter the first difficulties in terms of repaying credit to banks by the subprimes. In February 2007, risk premium brutally rises. In June 20, two hedge funds managed by Bear Stearns are on the verge of closing. And on July 2007, also premiums on AAA portion begins to rise. And as you may see, this means that there's a correlation between junk and AAA. What is at the issue is not so much the individual ability or of the rating society ability to assess risk, but the absence of a market benchmark. There is not a the recent after the contagion, a conventional judgment. There isn't a regulator able to govern expectation. And if you see, for example, this other graph that is very important for me, you can see that the distribution of losses according to whether the correlation is 0 or right can be hypothesized in different ways. In the rating agencies analysis, in the dominant model, the correlation of defaults among the securities, and obviously the correlation between junk bonds, or if you prefer, junk tranches and AAA tranches, is considered as a Gaussian. So the correlation has been underestimated. This is the distribution of risk. And as you may see, this distribution of risk is a blinding, because the real correlation is this one. The higher correlation that leads to a greater impact on senior portion that is computed by the area under the part that affecting the senior portion. And as you can see, the senior portion is seriously affected and is seriously correlated. Cannot be considered as just a tail of a Gaussian distribution. The phenomenon, is different. The statistics distribution is different. But what is the way to estimate the statistics distribution? Again, it's based on some hypothesis. And if you think the so-called traditional hypothesis,
but Stefano, don't go too far there, because the student has work only on the frequentist approach, and so I don't want to put a lot of stuff.
No. Anyway, again, the mark-to-market model is just a part of the coin. The other part of the coin is the idea that phenomenon can be considered by a traditional statistics modeling, in which the so-called mistakes are distributed as a Gaussian. And students,
of course, but we can have also a Bayesian estimation.
But students, I think.
No. Now we stop.
Introductory statistics course. An introductory statistics course that is not part of the program of your students.
No. Just a little introduction and just a few pillars. But anyways, Stefano,
anyway, this is an important perspective, especially for people that want to be expert in finance. The idea is that when you try to estimate a risk, you can decide. Generally, you decide the dominant model, also in the statistics, but the dominant model is based on restrictive hypothesis. And the restrictive hypothesis leads to an underestimation of the risks.
Yes, it says, I cannot agree more. Stefano, we have to change class, and we have to change class because of the time's up.
Can I have 10 minutes more?
10 minutes more? No.
No. Okay.
Just
so I may
1 or 2 minutes if you want to add something.
I may conclude. You will find in the slide also some part related to the problem of conventional judgment as Keynes introduced in the general theory. That is a very important notion in order to try a fair analysis of financial markets. And I also illustrated in the slides a very interesting experimental economics paper that can be considered a strength for the Orléans perspective. But my last slide could be at the moment the best way for concluding my discourse. As I said before, the problem in financial market is governing expectation. Is trying to fix an equilibrium by a benchmark, and only a regulator could program this benchmark. What happens if the role of financial markets becomes central in capitalism? As became and as was witnessed by Alan Greenspan at the beginning of my discourse. It happens that collective savings are drained from the stock exchanges of stock prices, and the financing of the economy shifts from banking to stock market and derivatives system. So the central bank, in this perspective, is forced to accommodate the crisis, to accommodate the demand for liquidity. Because in a mark-to-market model, if you haven't the demand must be rebuilt. And the only institution that may buy junk bonds will be a central bank. Central bank is somehow forced to accommodate the demand for liquidity from gradually increasing debt position. And it happens, and it happened, and this was the way to exit the crisis, that money, that the legal money by central bank has to support the reliance on publicly traded securities that were elected as a sort of near money, as a sort of derivative liquidity. But it was blinding, and we need to limit these behaviors that may lead all the system to a financial crisis. New, or if you prefer, an old way to be central banker, that is not the way that legitimate the mark-to-market model. Thank you very much for your attention, and
thank you very much, Stefano. And we will go on with Professor Fantacci this afternoon. So if the student have some question, you can write me your question, and then I will answer you, and I send this question also to Stefano.
You can obviously diffuse the slide to the student.
For sure, and also, even the recording.
They also find some references to deepen the point, and obviously they may freely write to my email address.
Thank you, Stefano. Thank you indeed.
Thank you to you. Goodbye to everyone.
Hi.